You've got a plan, you watch the charts, you put in the hours. But if your P&L is still not matching your efforts, here is why 7 pro-sounding trading myths are killing your edge quietly. The first myth is this: I've got a plan, I just need to stick to it. But most plans aren't real plans. I used to draw clean entry zones on my charts. I felt prepared, but mid-trade, I'll start justifying. Suddenly, I start forcing the plan to fit to what I want instead of what the market is actually doing. A real plan has a kill switch. It tells you exactly what to do when things go wrong, not just when they go perfect. So if you're not scenario planning, you are not trading, you're just winging it. Myth number 2, real traders have to watch the markets all day. Your brain is like a battery. It has peak charge in the morning or the start of your trading session. It's clean, focused, dangerous, but the longer you stare at your chart, the faster it drains. And once you're running on fumes, you start making stupid decisions. But by hour 3, you're not spotting A+ setups. And this is what I used to do. I used to sit for 6 hours straight, waiting for one more trade. But my best work was in the first hour. After that, it's easier to get into red trades, revenge trades, over trading, made up setups that kind of fit, and that is not trading anymore. Now I trade 90 minutes after the open, and that is it. That is when my rules hold, then I log off. If you want to have that long-term edge, you have to protect your battery, not screen time. Myth number 3, you need more discipline. Most traders think, I just need more discipline. But here is the truth, discipline isn't your problem, your environment is. See this glass of water? This is your discipline. All your willpower, all your focus, and everything you want to accomplish, that's this bottle. This bottle is your success. This is what most people do. You might gain a little success, no system, and everything spills. Now I'm going to clean this. The harder you try, the more it slips out of your fingers. And when that is gone, you're left empty, frustrated, telling yourself the same lie over and over again. I just need more discipline. But it's not about having more discipline. It's all about how you use it. Now watch what happens when I pour that same glass of water through a system. The water flows clean and controlled to your goals. No wasted energy, no chaos, just pure focus. Because this is what I used to do. I used to reopen my trades after shutdown, kept my alerts on, left scanners running. I started deleting my triggers, no more noise, no friction. Now I have a clear shutdown ritual, a planning ritual. Discipline doesn't live in my head anymore. It lives in the system. You don't need more discipline. You need to make the right ones easier and the wrong ones impossible. That is not mindset, that's engineering. Myth number 4, win rate equals higher profitability. Winning more trades means making more money. Makes sense, right? Until you realize that you can win 8 out of 10 trades and still be bleeding cash. This is a myth. If I just boost my win rate, I'll be profitable. But here is the real game. It's not how often you win, it's how much you win when you're right and how little do you lose when you're wrong. Some of my best setups have a win rate of less than 40%. But when they hit, it's at least a 1 to 4 trade. That means I can lose 6 trades and still come out green. If you have 4 losers of $400, and 1 win of $500, that means you still have a net profit of $100. I know, high win rate, that's comfortable, but real probability, that lives in asymmetric setups. Big upside, small risk. Myth number 5, good news equals green candles. If an earnings report is good, that means the price should go up. It sounds very logical, but it is wrong because the price doesn't move on numbers. It moves on expectations, on positioning, on who is trapped. Let me show you exactly what I mean by this. 2 weeks ago, I had the perfect example of this. I wrote it in my newsletter. Should I just read out the newsletter? Why good earnings drop and bad ones rally. Yeah, seriously. Let me get one thing straight. The earnings number doesn't matter as much as you think. Sure, it's important, but it's just a starting point. The real trade lies in understanding why the stock reacts the way it does. And right now, we're in a market with heightened uncertainty. Every move is judged harder. Every rally is questioned. Every dip gets scanned for value. Which brings us here. A stock posts bad earnings and rallies, and another stock crushes earnings and sells off. Confusing? Not if you understand the game. Here's the truth. Bad earnings can be a buy signal for investors. If a company stumbles but the long-term story remains intact, buyers may step in. They see it as discounted value and they scoop it up, and the sell-off creates an opportunity. And good earnings can be a profit-taking event for swing traders. If a stock has run into earnings, even a great report can lead to a pullback. Why? Because expectations were very high and early buyers are cashing out. The pressure can outweigh the headline beat. So don't just ask, was that a good report or a bad? Ask, what positioning was already baked in? Who's likely to act on this news? How is the broader market context feeling today? If you look at some of the trades last week, Sophie, strong earnings, weak reaction, but the stock, it kept up, then got sold into hard because despite the beat, the market had already priced in strong numbers. Swing traders took profit, buyers didn't chase, the open was heavy, and a fade gave my setup. So it's a lesson. Strong numbers don't guarantee strength, especially in uncertain markets. Watch what traders do, not what reports say. Okay, then we have XYZ, missed earnings early, but day trade opportunity was clean. The stock got crushed after hours, gapped down hard next morning. But here's where it got interesting for day traders. Okay, after the open, sell-off continued briefly, then stabilized near 44. Buyers stepped in, price formed a clean base. Once it broke consolidation, there was a new long setup around the 46.50 and solid follow through. So here's a lesson, a bad report doesn't mean no trades. When panic fades and a base forms, day traders get a second chance. You don't trade the report, you trade the reaction to the reaction. And then we have Starbucks, missed earnings, but intraday reversal delivered. The markets didn't like it. Stock got slammed after hours, gapping down hard next morning. But this is where being a trader, not a reactor, pays off. The open was weak, yes, but the price stabilized near the 76 level. Buyers stepped in and flipped it off the lows. A clear base formed, reversal. The lesson, bad earnings is a bad stock? Not always. The reaction after a flush tells you if there's real demand. In this case, the market saw value and the traders rode. The point is simple, you cannot predict the reaction from the report and you have to read the market's interpretation. And here's how to do that. Prep key levels pre-market, understand the sentiment going in, watch the open like a hawk, and let price action confirm the story. That is how I trade earnings as a day trader. Not by gambling on the report, but by responding what the market is actually doing with the news. To receive the newsletter, link is in the description. Myth number 6. Someone else their setup will save me. Let's say I pick up some random trader setup. Super high, big following. It's the same like picking their glasses and thinking, wow, now I can see better. Now I can't see shit. I don't know what is an opportunity. What is a reversal? When is it a solid breakout and a fake out? Meanwhile, I'm blind as well, but hey, the guru said it would work. This is the myth. If I just find the right setup or follow the right trader, I'll be profitable. I'll be consistent. But if you didn't build it, how can you trust it? Because the second it fails, you ditch it. You go to another setup. You try to find another system because it was never yours to begin with. I've done it. I followed Humble Trader, was in the academy. It made sense, but it just didn't click. I also watched plenty of Warrior Trading. I don't know what magic he is doing, but that is totally not my style. So nothing felt natural to me until I stopped chasing other people's setups and started crafting my own. My rules, my signals, my trade structure. And then is when things started to stick. You don't need somebody else's edge. You need a system that fits how you see the market. Your psychology, your risk tolerance. Wearing someone else their setups is like wearing someone else their glasses. It doesn't help you to see clearer. Myth number 7, more trades equals more opportunities. The more chances you will have to win. But most of those trades, they're not your edge. They're just ego looking for action. If I trade more, I'll catch more setups. But quantity doesn't build consistency, it buries it. More trades is more mistakes, more leaks, more fatigue. I've had days when I did the first few trades, clean, profitable, but instead of walking away, I kept clicking. And by the end, I gave away everything plus some. Or I end with a small loss and I couldn't accept my small loss and just one more trade. And a small red day became a very big red one. And it's not because the market had changed, it's because I couldn't stop moving. Great traders, they don't chase noise. They sit, they watch, they wait. And then they strike when it's obvious. Jim Rogers, he said it best. I just sit there until I see money laying in the corner. And all I have to do is go over there, pick it up, and I do nothing in the meantime. That's the game. Sit out the noise. Wait for your moment and grab it. Now you know the myths. But there is one more trap that still kills traders silently. Your own brain. That is the one mindset flaw that ruins everything. Click here to fix it.